Hey, fellow traders. Hope everybody is doing well after the holidays. And I just wanted to start this video out by saying that I have done quite a bit of tearing things apart and putting them back together. And I just wanted to go over a new perspective of the way I'm looking at things. And I'm just going to refer to this as a hybrid hedging type model. So, first off, let's just take a look at the differences between normal stop loss trading and hedge trading. When it comes to the first type, the standard stop, you're going to have a win or lose for every trade. You reset every trade. So that means you reset your risk, you reset your mindset, reset your analysis, and so on and so forth. You have a little bit lower risk and a much slower return because you have less capital in the market. It's a bit simpler. You don't have all these complex ideas to contend with. You just look at your strategy, look at your setup, and make your trade. Gives you a lot more freedom in your pair, your direction, time frame, so on and so forth. And you hold your own debts, which means you just basically accumulate your own losses. Now, if we go take a look at a standard hedge, this is basically where you'll have a stop loss or a stop limit order for the stop loss, and then when you decide that price may turn, you're going to cut that buy stop and you're going to let price come back down and hopefully take out your target for yourself. Now, with this type of hedging strategy, you will end up winning or breaking even a lot of times on your account balance. You're going to end up trading in sets. You're locked in by both your direction and your pair. It's complex to change your direction to where you can finish in a different direction in which you started. You end up with a lot higher capital in the market. You do end up getting larger returns as a trade-off, but just in general, it's a lot more complex than regular trading. You have a lot more math involved. You have your high watermark and your drawdown split going apart at double speed, which is a really big drawdown if you're going into a challenge, for example, to try to hedge. You're going to have higher trading costs in that you're going to be paying swaps. You're going to be paying for uh, double commissions. Your market does hold your debt, and that's what you're paying those extra trading costs for. You're basically paying the market to finance holding that trade open while you look for another reversal or another opportunity to make a trade. And you got to worry about other complex things like trimming, schematics, extra theories. You have to try to be a little bit more advanced with your technical analysis and so on and so forth. So that just makes it a whole lot more complicated than it needs to be. So what I've done is I've taken these two lists and I'm basically going to take a look at what do I not like about it, what do I like about it, and then what are some of the trade-offs in order to make everything happen. So when you're taking a look at hybrid hedging, the main thing we want to focus on is trying to win or break even. We're still going to trade in sets. It's going to keep the simplicity of the stop loss style trading. It's still going to give you that freedom for your pair, direction, and so on. You're still going to hold your debts, and that's something that we're going to talk about here in the next section. And you still keep a little bit higher capital in the market for larger returns, but you actually have a little bit more control over this higher capital in the market. So the main points that I'm going to focus on in the video, I've got a new calculator. It's mostly focused on account break even. Then we're going to look at some trading. Going to look at the risk viewpoint, the statistics and importance, the compounding advantages. We're going to look at it by break even and by outcome. Then I'm going to tell you a little bit about how my setup works and what I'm looking to do and just the different ways I'll enter into a trade and look to make a trade. Now there's two main phase ideas that I trade with. One, I just keep adding size and trying to get things right and make an overall account gain. But then after a minute, 4 or 5 times wrong or so, then that's what I'm going to consider an uncomfortable level. And then I'm going to start to keep my sizes bigger, but I'm going to size down just a little bit to manage that risk. and I'm mainly going to focus on reaching the account break-even point, just getting that account back to where I started. So this is kind of a variation on the Forex Gambit that I've been doing with the standard hedging style with all that complexity. I've taken the mechanics of that and I've essentially broken that down into what works, what's wasting time, what's stopping you out of the market, what's keeping you from trading, and basically eliminated that 3 week trade time, which is the most common with it. So I'm going to go ahead and switch over to the calculator. And we're going to take a look at the new calculator that I'm going to be using in order to do the new style of hybrid hedging. So let me get that pulled up for myself. And we'll take a look at that. So basically this one's going to be a lot simpler than the last calculator I had. The one that I had made before was made with Excel. This is done in Google Sheets. It tends to work a lot better with financial calculations. With this one here, you just simply type in your account currency, your leverage, your commission, when it's charged, and how you want to trade, and then you just set up your pair, and then the rest goes from there. Now, I've already got one started to work out for a current trade that I have in the market, but the first thing you'll notice after you start filling everything in is this little information box. This gives you the current price. This one stays updated a little bit faster than the last calculator that I made. This is also going to automatically convert your margin per lot based on your account currency to what you're trading. It's also going to work out that pit value per lot, and it works in either lots or units automatically. So all of these are prefigured, and these will work out the other calculations that are coming up. So let me set this back to lots. And right now I'm currently looking at the Danish krone as a 5 decimal precision. And basically, one of the beginning parts of the calculator, you'll see in this area here, you got a risk by calculation, percentage calculation. The newer calculator made a couple of updates, so this will be labeled a little bit different. But basically, you're just looking at a percent of your account to risk. So if I was looking to risk 3.5% of the account, I'm looking at risking $5.18. That's going to be based off of this account start that you're going to fill out here in the trade ledger. You're going to want to put that in first, and then that'll figure based on your account balance how much you're risking. Then you come to the next section. It's basically a best trade size, so you can determine your risk and put in the risk amount. What is the stop size for the current trade you're looking to take? And then you can also choose here whether or not you want to include the commissions in factoring in that size. It's also going to work well, especially with units. So with the commissions, you're looking at 2,100 units. That'll cost you $5 with your round trip commission. If you did not want to include commissions, you will be getting $21.97 for your unit count, but then you would be paying about $5.22 to open that trade. So I usually leave that on so I can keep the commissions accounted in with the risk that I'm putting into the equity. So this one's a lot easier and quicker to work with. Anything that's not in white or in these two columns here or in this little box here or right here, everything else is formulated automatic, so there's nothing to type in. Anything you see colored is automatically figured in for you. We can go ahead and take a look at this. You may be interested in looking at this from the get-go when you first look at determining your risk amount. This is part of that risk viewpoint that I'm going to get into here in just a second. But basically, this chart here is working out if you take this trade with this criteria, so with this stop size and with this target. This will be your first trade, and you're going to use $20 in margin to open this position with that leverage setting. You're risking $2.02 on this pair with that size of stop and that size lot. And this will be your total drawdown of the account if you should fail this trade and get it wrong at 130 pips stopped out. This column here is going to show your equity of what your account will have in it after you lose this trade. This will also account for the commissions, and this gives a percentage of drawdown. So if you're keeping an eye on like a lockout percentage for challenges or just an overall personal goal of drawdown percentage, this will tell you what this equity is if you lost this trade. Number one, that will be your percentage of drawdown from where you started. This is automatically figured in. It'll also come from this spot here. And you can just keep going down the line and putting in different trades to see what the negative side of it. Once you get to the next column, next group of columns, this is going to be the positive side of this trade. So if we look at trade number one again, if we were to win this trade, we would actually make $8.68. Looking at that target of 580 pips, this would give us a true gain of 868 because we don't currently have any drawdown if we were to lose. We haven't lost anything yet. We're starting a clean trade, so there's no drawdown. So you would actually be gaining $5.86% equity of true equity gain on the account, and your true R ratio would be 1 to 429. That's also with commissions included. On the next column, this actually takes into account your break even. So this is based on this drawdown here is figured into here. So this is how many pips, if you were to use this size, this is how many pips you would need in a positive direction in order to recover this drawdown here and get back to your starting point. So this is the break even column of how far you'll have to go based on that size. And then now you'll start to notice the gain differs. This is because now your true gain is taking into account the fact that you lost $2.02 on the last set. So it takes that away from your target if you were to win this trade, and that will be your true gain. So then you would be looking at making a 5.1% gain on the account overall with these two trades. And your true R ratio of gain would be 1 to 372. And it continues on down the list until it gradually gets worse, because eventually you're going to reach a point where you're going to have to get exponentially larger in order to make up for this. But the way things are set up, if you were to come and look at just an automatic automation of that, if you were to just go and compound up by adding an additional single size each level, so you trade with O2, the second trade, O3, 4, 5, 6, 7 down the line. This here will basically show you the outcome based on just a single setup of variables. You'll notice some of these columns are turned red. This means that the amount of margin required to open this position is greater than the amount of equity that you would have in the account at that point in time. So if you see something like this on the drawdown chart, you may want to make a plan to either adjust your approach to that point to where you get smaller sizes to lose less equity if you fail, or you may need to add in additional capital in order to support that additional margin. Right now I'm going to be using a USA account. This is going to work on a single account, so I don't need double accounts for hedging. I'm going to be running this strategy where basically, for example, if you take a trade and you get it wrong, you get hedged out. Normally that would count as drawdown in the market. Instead, I'm just going to take a stop loss, and then I'm going to take that amount and I'm going to put it here. And then what I'm going to do for the next part of it is I'm going to visit the next trade outcome section of the calculator. And this bases everything out of this area here. This gives your true total drawdown off of your starting balance. Gives the amount in dollars. And it will figure this out balanced, whether or not you are already positive or how far you need to go. Everything is figured based from the starting balance here. So if I were, for example, I've already got one set up to take a trade of 0.02 lots, and I'm looking at a 158.3 stop size, which is the current trade I have on right now, and I'm looking at a target of 417.4 pips. This is going to break down the entire outcome of what's going to happen when I open that position, what's going to happen if I fail, what happens if I win, and then it's going to take into the account the fact that I already have $2.92 of drawdown. It's going to also factor in the commission of this trade, and it's going to factor out that, okay, even though this trade made $12.15 at a gain of 8.21%, it's a 1.249 to 1 risk reward. This will actually give a 1.189 risk reward on the trade set itself in order to use the starting balance as the starting risk point. So that will give me a true gain outcome if I should win this trade of 6.24%. Now down here, it'll show you what the equity is if I lose this trade. So I'm looking at 145.13 right now as the current equity. If I get stopped out with those parameters, my account would then be at 140.25. That's commission included. And this is showing the margin required if I were to open that 0.02. And this just gives the margin numbers of what you would see in the account after you open the commission with the percentage. And this includes this setting here. So if I were to set it to on open, it would charge the full commission on open, and that number would drop another 10 cents. Uh, and that would conclude the calculator. This one's a lot simpler to use because really all you're focused on is this distance to break even. And this R ratio on break even takes into account this stop size to this distance. So you could also adjust your size later on down the road. If you had a little bit higher drawdown, you could adjust this size in order to try to make this distance a little bit less than what you're looking to target, and then you could easily clear out to break even. Even after being wrong 5 or 6 times, you could clear back out to break even quickly and easily with just that one trade, and then start back over and go back into that first phase where we're going and taking the idea of where we're just trying to add and get things right and make an overall account gain. Now, if we want to go ahead and take a look at that from a risk point of view, excuse me, basically what we're trying to do, or basically what I'm trying to do with my trading strategy is doing the compounding. I could show easily with the charts here. You notice that as you get smaller, or as you get further away, you need further and further to go. So if I were to change this to a 0.01, for example, you could also see here how that distance is just getting further and further away for break even. But if I start to slowly increase that size, it steadily keeps that break even distance under a reasonable target distance, because on the Danish krone, it's pretty common to have between 120 to 150 pips stop loss, and you can easily target between 5 to 600 pips. A lot of times, 400 will be a more common stop, but I'll show you why I use those numbers here coming up next. But this is the reason why compounding works to your advantage, because you can see that it's not going to bring the account down extremely hard until the fifth or sixth time, and by the sixth trade I would be out of margin at that point. But I know if we're going back and taking a look at what we looked at in our PowerPoint, it's basically the statistics. And the reason this compounding works by break even and by outcome is because I know most commonly that my hit rate is going to get me right between 3 to 5 times out of 10. On a good month, I'm getting 7 out of 10 or more. Everybody has their streaks, win and loss. I'm no different than anyone else. But I know that most commonly by the second or third time, I'm going to end up being right. So if I'm going to be right by that point, then I should easily clear this out before I have any troubles with margin. Now, if I'm going to be wrong more than that, if I'm having a losing streak, then by the fifth trade or so, I may start to reduce. I may start going back down to a 0.02. And then, if I still didn't get that, I may do another 0.02 again. And if I'm still losing by that point, then I may still go get even smaller still until eventually I start winning, and then I start to bring that size back up again and start reaching for that break even point again. So this would be how I would preserve the capital of the account, and preserve going too deep to where I can't use margin, but still also be able to try to attack that break even point and get myself out of this hole much faster than just trying to stay with the 0.01s all the way through. Because you notice how how fast and how far away that thing can get after a few times of being wrong. So I would always advise to try to do some type of compounding in, or some sort of at least sizing up gradually and changing your sizes gradually. And by using the calculator, you can definitely help yourself knock out this drawdown in one trade and actually make 4, 5, 6 attempts to actually try to knock this out in one trade. So that's going to conclude the calculator. I'm going to leave a link for this one in the description. Like I say, this one's a lot simpler to set up. All you have to do is worry about setting these up just the first time. If you ever want to change pairs, you just come and type the new pair, set the precision, and you can carry this on through. So if you decide you're done trading Euro USD, for example, and you want to try the USD JPY, you just type this in here and carry on like nothing happened. So let me see if nope, I don't have that. So you would do that, and then you would change the precision to get the right values. And now we're looking at a new potential. We'll have to set up the new uh, targets here. I think we're having somewhere around about, I think it was somewhere around about 120 there. And then, or no, our stop size was about 50 that I normally use, and a target maybe about 120. So even that would be a bit of a larger size, because Danish krone is quite a bit smaller, and even still, that would be looking at a considerable amount in regards to the change there. I also get less leverage on Orlando. So I would be able to set all this up rather quickly and be able to find out, okay, this is exactly what I'm working with, and this is what I'm going to be able to do. I can quickly change my numbers, look at what I'm doing, and see exactly what's going to be happening with the account as I go through and make my trades, and all this will just carry over. And then, of course, the chart will update automatically to go for the new values on the new pairs. And for this, you just have the 3. And for this here, you just have that white box. And then for the other parts, you just have these 3 white boxes, these 2 white boxes. This one here is important, your risk, and then your settings here. You'll need to take care of along the way, but it changes very quickly and is mobile friendly. Now, it's possible if you have an iPhone, you may need to use this on PC. I apologize for that. I'm still working on trying to make things as compatible as possible. The best way to do that would be a web server. So if you want to support that upcoming project, leave these little links in here. And anything that's put towards that will support the web server, the channel, and any future development of calculators and trading tools. And next, I want to go ahead and take a look at the next part of the ideas. We've already talked about our risk viewpoint and statistics and the importance of it. So we know that if we're wrong 4 to 5 times in a row, we can manage our drawdown chart to work with how many times we're going to be right or wrong. That way we can optimize that and keep our account going up instead of down. So next I'm going to swap over to TradingView, and we're going to take a quick look at that. And I'm going to show you the way I kind of approach my trading, the way I will set things up from the get-go. There's my current trade. I set that up earlier and called it out in my group. If you want to join up the group, that link is in the channel description. Excuse me. But basically what I start out with is, you'll notice I have a lot of lines. This is commonly referred to as zebra trading. But I've noticed a consistent pattern with these things over my years of trading. And one thing that I like to use is the flip zones. One thing that I'll start with, this one maybe not so important, but what I'm going to be doing essentially is looking for a pattern of levels. So if we look, we see that this is about 350. So you'll notice that you'll start having these little patterns of levels. And then on the smaller levels, those are going to be a more consistent size as well. We had a major news event happen there, so we'll adjust these to try to be closer to a normal size. But basically, you're going to start looking for patterns in the levels. They're going to be kind of close together. One thing I like to use are wicks and sharp points where things come together. And then you'll notice that these little sharp points tend to be flip zones later on in the future. I'm already looking at a couple of different ones more up to date. The most relevant ones are going to be the most recent leg that it's come down. So if you're coming back up, these levels here are going to be more relevant than ones further back. But you'll notice they also follow kind of a similar pattern. And I'll use these levels to try to determine trading points. This is where I might want to take my entry. This is where I might be looking at a rough spot or a rough choppy zone. Went ahead and marked out a few of these minor levels where price kind of broke through. It broke across the trend line, made a little bit of support, but then came back below it. So I'm just going to consider that a minor level. And these are coming back from before, from other spots. So there's a breakout zone there that I marked, and then another little area where price kind of broke across this trend line as well. So I marked that out. Those tend to be relevant in the future when price comes back to it. And you notice those lines that I marked out, you can notice how price is starting to play around and respect those. And now I've got these two marked out for in the future. And I'm basically just using these as a reference. So if price is, for example, hitting this level and staying off of this level, you may want to take a long position here and target here. But then notice how it's coming in. It's more of resistance here on the top. So you notice it's kind of rejecting off. So you may have wanted to go short here. You'll notice how if price is staying on one side or the other, unless it breaks, tests, and breaks away, or is more in line with the overall trend, it's likely that if price stays above it, it will go up, and if it stays below it, it will go down. But of course, uh, you're going to have these different situations, like right here, where it stayed below, went above, but then broke back below, and then this one was below and then broke back above. So it's not always perfect. It's not really there's no real predictive power in it. But the main part about it, of why I use it this way, is it gives me a good, reasonable way to control the risk. I know one of my favorite things to do is to try to figure out, okay, if I have a pattern like this, the easiest thing to do, and this works on just about any pair, if you're looking to start out trading a new pair or even make an adjustment to a current pair that you're trading with, you can take this total distance. So we're looking at about 284 pips on this distance. So if you divide that by 3, and I don't have the calculator set to the, uh, let me add this on the screen real quick. And yeah, yeah, yeah. Never mind, it's not gonna let me do that right now. Yes, it will. Here we go. Let me go back to that. I did not have that set up. So let me just put this back on and I will work it out real quick. So we had 282 pips, and I normally will take 1/3 of that distance, so divide it by 3. And that will give you a number that is 94. So even if you take 300 divided by 3, it gives you about 100. And I'm using a little bit lower or a little bit larger stop because it has a lower pip value. This calculator here you can actually find on my TradingView profile. This is a currency converter and more of a sizing calculator, but I will typically use about 120 pips or 1200 points on the Danish krone, and I'm going to switch this to just a single lot, and you can notice how small the pip value is, so I will leave a little bit more room for that. But for example, on the Euro USD, for that type of setup, you'll notice that it's more common for the levels to be around about 90 or so pips apart, and in that case I'll end up usually using around about a 30 pip stop because of the 90 pip distance. So I would set up something like this on a Euro USD. I have another chart and another setup, but just doing it real quick, you notice the flip zones coming through. We got some strong rejection points. Price was showing support, then flipped to resistance, and now later on when price comes back down to this point, it should show support off of these levels, and these are the most relevant ones on the down leg. You could also rely on these for the up leg coming down. This will more than likely wind up about right there, and just kind of look for where price is flipping from one side to the other, and then we'll do a quick measurement. And that's about 52. There's about 90. So there's a major level. You see the major range. And then if we go from there to there, you notice there's 90 pips there to there from those points to those points. And then 180 overall. So if you divided that by 3, that's where I usually get my 30 pip stop from. And then a lot of times for targets, I will either target a major high, or if, for example, if I was to take a trade in here, I'm usually just going to base it off my own judgment. So, like, for example, if we were in that situation, I would try to target at least 2 levels up. So I would probably target somewhere around in there. And my stop would then be around about here, and or even there or so, just under that low, under this consolidation area. So if I was to continue that, that's how I would approach that type of trade, and I would take that trade directly off of that major level, which is at that 90 pip mark there, and that's what I would consider a major level, and that would end up making about a almost a 3-to-1, a 275 our trade off of that. And then, should you want to continue and hold that out further, you could even trail that up and look for the next level up. And if I didn't know what that was, if it was a new high, I would just do it exactly like this. I would measure up the most common size, and I would just drop a line right there. And if I was going to target that, I would then raise it to there. And I would imagine that might hit because it's pretty typical for the euro to kind of trend up and then spike above and then come back down. So we could see that happen later on in the week. If you're first catching this video, that might be something to consider. Look for that level off the 110.8 and take a short off of there, more than likely, with your stop at 111.1 is more than likely what I would try to do. That'll probably be the New Year's trade, so we'll see how everything works out with that. But that's basically going to conclude how I'm looking to trade. And then, of course, if I got that wrong, if price were to just suddenly dip down below, if it were coming down here, it goes up, and then bam, it takes me out, then I would look to just do the same thing again, and I would consider that one a loss at that point, And then I would just look to make possibly another trade off of this area here using this line. Even though it's a minor, I might even consider taking a trade if it's showing some price action. Like, for example, here is a pretty nice pattern. You've got a triple tap. We've got a nice solid line, nice solid major, a minor support line, but we've already got a break and retest here. It's retested it a couple more times, so that might actually be a safe trade to take if you get stopped out of the first one, for example, and looking at the same strategy, and then of course target the next major, the second major level up, or you could even just target a basic 1 to 3, 1 to 4, depending on how you wanted to do your risk tolerance. And that would be a couple of trades that I would look at for trying to go with this uptrend. And then I might even look at some other things when it comes to technical analysis. This is technical analysis is really just your way of understanding the market, and I'm seeing that as a trend line, but I would probably go with something like this, and I might be using something like that to consider a trade. So starting to show some weakness, a breakdown here, so it's possible we could spike up and come down. That's another read that I might be looking at for the Euro USD for a New Year's trade for 2024. So basically, you can just look at this kind of however you want, apply your own strategy. That's just the way I kind of handle things and do things. If I would have lost that trade, then of course that would have been, and if this was a .01 lot, for example, then the next trade would have been a .02, and that would have made a very short distance to my account break even. That would have been roughly 15 pips or so on the euro for that one. I know that one is what it is because I've run that one quite a bit and seen that number quite a bit. It would be about 15 pips roughly. So that's just my approach to trading and the way I kind of approach my entry. Everybody has their own strategy, and each will have their own preferred time frame, their own length of time to hold, their own patience level, and so on. I don't typically like to use indicators. I'm kind of playing with a few right now, but I really don't use indicators too much. I'm more of a price action trader. Like right now, I'm watching this line and I'm just anticipating there's going to be a break. Same logic as what I was just looking at the Euro USD. There's a break here where it failed and got back below, but that's showing a breakdown of where it kind of wants to stop going along this common line and try to break up. So there's a little bit of buying pressure in the market, but it's not quite ready to go. This could also be what you could consider like for example, that's not a rotated box. That could be like a channel, for example. So I know a lot of traders will look at channels that is, for example, that rising channel on a continuation. So a lot of traders went short, took that. But at the same time, we're looking at a break and retest right here at a consolidation. There's a huge breakout here. So I'm going to read that as buying pressure in the market. It's just not quite ready to go up yet. So I'm trading for it to reverse down here. So that's kind of the logic behind my current trade that I'm looking at. And it's pretty much just the same concepts and same ideas. And it would be the same idea if I was coming short, like I talked about a little bit earlier, where it's already tested a couple of times. I might have even taken that, or I might have went in here. For example, my patience sometimes gets a little thin waiting for those retests, but I may have gone for something like this or even something like that, and that would have worked out to been a fairly decent trade. If I had a little bit more patience, I could have held out for that to give a 1 to 4. A lot of times I'll see 1 to 3 to 1 to 4. The euro, I'll see 1 to 4 to 1 to 6. If we get a good news trade, I might see like a 1 to 10. I've seen up to 1 to 14 a couple of times before. So the euro might be a slow and steady mover, but if you catch a tight entry, you can get some really nice trades off of that one, and that is actually my favorite one to trade. I've just been kind of playing with the Danish krone here a little bit. I like the way it moves. And even though it looks like it's moving a lot of pips, this 417 pips is more like the euro moving about 40 pips. So it's a lot of pips, but it's not as exciting as it really looks. And that is going to take care of it for the main ideas of the video, the main ways I trade, and that should break down everything of what I'm doing and give you a high understanding. I know this may seem a little confusing with all of the different ideas with hedging, but if we go back and take a look, basically, as we go through and look at what's happening with our hedge type trade, let me get back there to it. All right. So if I pull this back up and we start looking at the way the hedge trade works, so basically what I'm putting in that list is what you're holding in the market right here in this stop loss. Now this would be a buy stop above here, remember that? And at this point we would decide, in this video we decided we were going to close that buy stop for the gain and put in a new hedge stop order there. And this would be basically that drawdown part on that chart. And right about here where that line is on the short tool, that would be the account break even tool. That's mainly what the calculator is trying to keep up with for you. And you're basically working the same ideas. You're just not paying double swaps. You're not paying double commissions. You're paying a single commission, and you're not really paying swaps at all, unless, for example, you did something like what I did, where I ended up taking that trade just before and ended up paying that rollover fee just because I got in a little bit early. I got in about right there just before market closed, about an hour and a half before market closed. So I paid that swap, but of course I could have waited, got a better price, and not paid the swap, and I didn't really have to. But I got a little impatient, and that just kind of where it tells on me for what I'm doing. Because whether I get in here or I get in here, I still have to wait. So we'll just find out what happens with this trade, and I'm going to leave a link for the calculator. It's also got a link for a couple of different tools, link for TradingView. So if you haven't signed up for TradingView, you can certainly use that link to get a quick link to it. And then just search for Forex Storyteller, and you'll have my calculator on the scripts page. It may not be titled risk calculator, but it's going to be that first script on my page. Uh, may be referred to as Scalper's Toolkit, but you can grab that and this will automatically calculate your lot sizes and all, kind of the same way that we can calculate it here on the calculator. So it basically does the same thing here. It just does it by updating automatically. So you don't have to worry about typing everything in on that calculator. You'll just double click this, go in through your settings. Just remember right now you would have to type this in points. I have to add a little bit more code to fix this, so you'll have to use it in pips. And this will say your R ratio. If you want to use the ATR to set your multiple, a lot of times 2 is the most common multiple for that. There's a few different setups you can configure however you want it to look to fit your style of how you want it to look on your chart. And then you can actually set it up in 9 different places on your chart to get it on the bottom or the center or however you want. There's 5 different sizes as well. Tiny is the best for mobile. It looks small there, but it's great for mobile. And then you can customize the colors, your border sizes. You can actually put a little bit of a border around it if you like, or take it completely away. That's totally up to you. And then you've also got these cell dividers, so that'll change the look as well for you. Then you type in your account currency. This will automatically convert. So if you're using euros, just type in the 3-letter code, your symbol if you use a different money symbol, and then you notice this automatically can get converted for the pip values. And if I'm using DKK, if I'm trading with Danish krone, notice how it went and registered to the default pip value. But I'm going to swap that back to US dollar before I confuse myself. And then it also includes this fixed dollar amount or percent based risk. You can show or don't show your account size. And if you are to make something that's a little bit higher than what you're willing to risk, it will actually change the color to show you that you're using too large of a size or you're risking too much of a stop. So that is a good way to keep an eye on yourself, especially when you're scalping. So I'm going to set that back, but you can make a lot of different adjustments. The stock settings I have not worked in yet. That's a different contract size, pit value, and of course when you get into futures, things like that. So those are going to also be different setups. So just keep in mind this is for Forex right now, as well as this Google Sheets. We're gonna I'm gonna try to add gold to this because I know gold is a really common trading instrument. It has a different contract size. It uses a 100 size contract instead of 100,000, and also requires a different source. So I'm gonna try to get this in over the next couple of days. This way we can trade gold as well. I'll have to reroute this setting and try to get that worked in. But that'll be next to gold, the silver, and a few other commodities. And then we'll just take it from there. If there's any other things that need to be added to it, I can probably discover a way to add to it, but I would really like to get this thing on a server. So drop a little bit here and I would certainly be able to get that server going and certainly get a more robust and stronger calculator. Also be able to get the other calculator, the account emulator, working a little bit better. But that's going to wrap it up for this video, and I thank you for stopping by, and thanks for watching all the way through. If you love the video, you love the calculator, give a thumbs up, and certainly subscribe. I'm going to be releasing more videos in the future. I found a nice little video setup, so now I might be able to record just a little bit faster. But that's going to conclude everything for now. Thanks very much. I appreciate your support, and you guys have a great night, great day, great new year. Let's get ready to take over in 2024. Have a good one.